Hello, Amaka. Have you started? I could hear your mouth going like that.
We've started, Josh. Yes, we have. Good morning, everyone. Welcome to the webinar. This webinar on the revised transfer pricing regulations in Ghana. We're so happy to have every one of you join us on this webinar. It promises to be a very interesting time as we discuss the key changes in the transfer pricing regulations in Ghana. My name is Amaka Samuel Unyani. I'm a director at Andersen in Nigeria, and I have with me seasoned professionals who will be answering some of the questions that you provided while registering for this webinar. I'm going to be your moderator, and I'll be asking them the questions that you wrote down while registering. However, if you still have some questions that you would like to ask, feel free to drop it in the chat room in the Q&A box, and we'll take as many questions as we can. To provide some form of an agenda to the webinar, I will start off by giving a brief summary of the revised transfer pricing regulation, just the key highlights. Then we would go into the panel session. So without further ado, I think we can start. So the transfer pricing regime in Ghana has evolved over the past decade. Prior to 2012, like other jurisdictions in Africa, Ghana had general anti-avoidance provisions within its laws. However, in 2012, the Ghanaian tax authorities introduced a transfer pricing regulation that provided specific guidelines on how to treat related party transactions. In 2013 as well, practice notes were issued to provide specific guidance with respect to methodologies. In 2015, the Income Tax Act was introduced specific anti-avoidance provisions in some certain sections. However, in 2020, right in the middle of the COVID-19 pandemic, the Ghanaian tax authorities introduced the revised transfer pricing regulations, which really incorporated some of the recommendation from the base erosion profit shifting action plans. So what are some of these changes? To start off, the revised regulation aimed to simplify its application. The 2012 TP regulation was very broad, and it included various arrangements, including arrangements between an employer and an employee. So if an employer, for example, should give a loan, a car loan to its employee, the regulation requires you to test that type of transaction, whether it's reasonable from an arm's length perspective. However, the revised regulation aims to simplify its application more in line with the OECD transfer pricing guidelines. And basically, it states that the regulation will be applied to arrangements in a controlled situation as defined by the enabling law or any other enabling act. I'm sure as we go along the panel session, the panelists will provide a bit more clarity as to the application of the regulation. Another important change in the TP regulation is with respect to risk. The regulation emphasized the importance of risk in determining the reasonability of a transaction from an arm's length perspective. Basically, the higher the risk, the higher the reward. And the regulation basically states that the Commissioner General is allowed to make adjustments where risk is not commensurate to the returns that's being earned. The regulation also aims to remove ambiguity with respect to specific transactions and the treatment of specific transactions when dealing with related parties. One of those transactions is the intragroup services. So the regulation states that a benefit test analysis must be carried out for intragroup services to demonstrate its reasonability. It also states that costs arising from duplicative services or services which provide incidental benefits to taxpayers are not considered to be at arm's length. With respect to intangible property, the regulation aligned with the OECD guidelines and basically stated that certain factors such as which entities perform the development, enhancement, maintenance, protection, and exploration functions should be put into consideration when analyzing intangible transactions. It also included specific guidelines for cost contribution arrangements. So multinational enterprises who enter into such cost contribution arrangements would need to provide certain information in demonstrating the reasonability of such transactions from an arm's length perspective. With respect to financial transactions, the regulation was very specific as to how to, what type of interest or loans fees should be applied to financing transaction. And an interesting addition to that, to the regulation, is with respect to trade payables. I mean, taxpayers for a long time have been unsure as to at what point will a trade payable that has been left unpaid for a particular period, at what point would you need to apply interest? Now, the regulation states that a trade payable that has been outstanding for more than 12 months, interest should then be applied on it. Also, the transfer pricing regulation in Ghana aligned with its counterparts in other parts of Africa by adopting the three-tiered approach to TP documentation. So taxpayers will now be required to prepare master file and local file, and they would also, multinational enterprises who meet the consolidated group revenue threshold of 2.9 billion will also be required to prepare country-by-country reports. The interesting thing about the regulation is that the master file and the local file are now required to be filed 4 months after the accounting year end. So if you're a company that have an accounting year end of December, you have up until April, the ending of April, to file the master file and the local file. The regulation also introduced a simplified approach. So basically like some form of safe harbor for specific transactions. So taxpayers who fall under this safe harbor may not be required to prepare contemporaneous documentation. So those taxpayers may not be required to prepare the master file and the local file on a year-to-year basis. So for example, it stated that if your total controlled transaction is less than the Ghana cedi equivalent of 200,000 USD, you are not required to prepare master file or local file. You're not required to maintain documentation contemporaneously. Similarly, for entities who enter into technology transfer agreements, and such an agreement has been approved by the Ghana Investment Promotion Center, and the terms of the agreement is that the amount charged does not exceed 2% of net profits. That taxpayer can then apply to the Commissioner General to be exempted from preparing contemporaneous documentation with respect to that particular transaction. So then on low value adding services, these are services that are not of high value. They are not the core of businesses. Oftentimes they are called support services, things like accounting services, for example. Such low value adding services will be deemed to be at arm's length if the taxpayer adopts a cost plus methodology in testing that transaction, and the markup applied on the cost of providing that service does not exceed 3%. That taxpayer can also apply to the Commissioner General and ask to be exempted from maintaining contemporaneous documentation. Lastly, with respect to penalties, there was no specific penalties included in the regulation. Reference was rather made to the Revenue Administration Act of 2016. So this is a brief summary of the TP, the Revised Transfer Pricing Regulation. And now we will go into the panel session. I have with me very seasoned professionals who will be joining me in answering your questions. I will just briefly introduce them. I have Mr. William Kofi Owusu Dimitia. He's a lecturer at the School of Law in Ghana. He holds a Bachelor of Laws from the Kwame University of Science and Technology. He's also a member of the Ghana Association, the International Fiscal Association, and the International Bar Association. So William has also contributed to the Ministry of Finance Ghana's workshop with respect to drafting policies for safe harbor provisions in transfer pricing regulation. And he has also been involved in the exchange of information for custom valuation and the transfer pricing regime in Ghana. Thank you, William, for joining us on this webinar.
My pleasure.
Also, I have Mr. Kwame Omusu. He's the managing partner of TP Africa and also a former head of the transfer pricing unit in the Ghana Revenue Authority. He holds a Bachelor of Arts degree from the University of Ghana, and he's currently the managing partner of TP Africa. Prior to that, he worked several years at the then Internal Revenue Service, and he rose through the ranks as a senior tax officer to being the special assistant to the Commissioner of Internal Revenue. Thank you so much, Mr. Kwame, for joining us.
My pleasure, madam.
Next, we have Mr. Eric Mensah. He's the partner of Sam Okuzetu and Associates Ghana. He's in charge of the tax team. He's a specialist in tax legislation and played a major role in drafting the new tax laws for the Ghana Revenue Authority. He has in-depth knowledge in transfer pricing and was responsible for the mutual agreement procedure with respect to tax dispute resolution. Thank you, Mr. Eric, for joining us.
You're welcome and happy to be part of this webinar.
Last and definitely not the least, we have Dr. Joshua Bamfo. He's the partner and regional transfer pricing head at Andersen Africa Middle East. Dr. Bamfo has over 15 years working experience specializing in transfer pricing while working for the big four firms in the US, South Africa, Nigeria, and Ghana. He's an ardent speaker at TP workshops and webinars. Thank you, Dr. Josh, for joining us.
Thanks, Amaka.
Okay, so we're just going to dive straight into the question. And this question is for Mr. Eric. I said earlier that the 2012 regulation was quite broad and it covered all sorts of arrangements. And I did notice that the revised TP regulation aims to simplify its application. Please, can you explain which relationships now fall under the purview of the revised transfer pricing regulation? Mr. Eric?
Thank you, Amaka. Thank you for that question. I think if you look at 2012 TP regulations, I would not say it was that very broad because it listed the number of transactions or a list of transactions who fell under those regulations. I mean, for example, those that you mentioned in your earlier presentation. So you could argue that technically, depending on the rules of interpretation, and if a person or a transaction did not fall within the list provided under LI 2188/2012, and with some creative tax planning, you could escape the application of the transfer pricing regulations then. However, the current TP regulations, LI 2412, it's rather broad and encompassing. I say so because if you look at LI 2412, you mentioned that it simplifies everything. It applies to an arrangement between persons who are in a control relationship under the Act. So that's a very broad definition of the application of the TP regulations to persons in a control relationship. And then you will have to then go to the Act 896, that's the Income Tax Act 2016, and find out which of those persons the Act is referring to. And if you look at Section 128, the controlled relationships that applies under the transfer pricing regulations are that of an individual and a relative of the individual, that of partners in a partnership, an entity and a person referred to in subsection 2 of this Act, that is Act 896, and then that of a settler, trustee, and beneficiary of a trust. And it goes further under Section 1281E to even cover acts in accordance with where a person acts in accordance with the directions, suggestions, requests, or wishes of another person, whether or not they are in a business relationship, that could then fall within the purview of the transfer pricing regulations because it comes under the definition of persons in a control relationship. If you also look at subsection 2 of Section 128, It also provides that where a person and an entity are in a control relationship, and that person may benefit from more than 50% or more of the voting power or rights to income or capital of that person, whether alone or acting in concert with other people, the law presumes that they are in a control relationship, and then by implication, they would fall within the transfer pricing regulations LI 2412. And further, when you read section 1283 further, and by implication, again, applicable to the transfer pricing regulations, the Commissioner General is given very broad powers to determine which transactions are within the ambit of the transfer pricing regulations. So I would say that the LI 2412, it's a very broad, encompassing legislation in terms of TP. So it would be almost impossible to really extricate a transaction or persons in control relationships from the application of LI 2412. Thank you.
Thank you, Mr. Eric. So clearly, the simplicity is actually much broader than they had included in their regulations. It's much broader. You have to go into the acts to get more information. Thank you for that, Mr. Eric. Dr. Josh, one of the significant change in the Ghanaian TP regulation is the adoption of the three-tiered approach to TP documentation. How can businesses comply with this requirement, and what are the implications for businesses?
All right, thank you, Amaka. First off, I think it's important that we make a clear distinction between two major groups of compliance requirements that businesses have to meet. The first, which is nothing new, is the filing of transfer pricing returns. And this is basically the disclosure that a taxpayer has to make, because, tax administrators need this information to perform their risk assessment, functions. So that is not part of the three-tiered TP documentation. That is just a disclosure of, relevant information about, that tax-paying entity, its associated enterprises, and the type of controlled arrangements they do have with such entities, and the value and stuff like that. So that is separate, all right? That's the TP returns filing. Now let's go to the question itself. That is a three-tier TP documentation. And this is an alignment of the revised TP regulations with what we have in the OECD guidelines, the 2017 version, which is an offshoot of the BEPS initiative, which was also driven by OECD. And what it does is that there are three documents that we are talking about here. Previously, we're just talking about one document. So if you look at the 2012 version of the regulation, we're talking about preparing TP documentation, right? And in that TP documentation, there were sections in terms of the fact gathering sections that was predominantly focused on the group itself, because one needed to understand, the key value drivers within a group and some information about the group, even before we come to the tax-paying entity and its control transactions with its associated enterprises. Now, under the revised TP regulations, which is in line with the OECD guidelines, they recognize that to reduce the cost of compliance on, taxpayers, these general, information about the group could actually be grouped into one particular report called the master file, so that you don't have a repetition. Just to put it in proper context, if you have a global multinational enterprise like the Coca-Colas of the world, which has presence in over 120 countries, and in all those 120 countries, they have TP documentation requirement. In the past, what you would then have to do is prepare 120 separate TP reports for each jurisdiction, which contains the same general group information that you have to replicate 120 times. Under this new three-tiered TP documentation, your master file, which contains information about the group, could be prepared by the ultimate parent entity, for example, and that could be used by all the other 120 jurisdictions. Then the local file would then be jurisdiction specific based on the control transaction that local entity has entered into. So that's the real idea behind the distinction, between a master file and local file under the three-tiered TP documentation. So your master file clearly will have content such as the organizational structure of the group, what are the key value drivers within that particular group, what are some of the intangibles that the group uses in order to differentiate itself within its market or its industry, and almost every relevant information, such as financial transactions that are specific to the group as a whole. So that will be contained in a master file. All right. Then you come to the local file that is specific to the local entity that is preparing that TP documentation. So there's going to be some information about the company analysis. What are the key success factors of that particular company? What are the control transactions that they've entered into? And that is very important. And out of those control transactions, there should be a functional analysis, which looks at the functions being performed by the entities involved in that control arrangement, the risk being borne by each of those entities, and the assets being utilized. Out of that functional analysis, you can then characterize, these entities involved in these transactions. And out of that characterization, you can then select an appropriate, the most appropriate methodology to apply to determine the arm's length nature. Then you apply that particular methodology, perform a financial analysis, then you draw some conclusions whether you met the arm's length principle. So that is what we have today under the revised TP regulations, the fact that the TP documentation has been split into two, which is the master file and local file. And remember, the purpose of this document is the fact that it's the first line of defense of the taxpayer to demonstrate to a tax administrator that all their control transactions have been conducted in a manner consistent with the arm's length standard and any safe harbor provisions that have been provided in the regulations. Now, the third element, which is a country by country report, is really the newest introduction. If you look at the TP documentation, it's been in existence. It's just the form that has changed. But to country by country report, this is something really very new, and it's an offshoot of the BEPS initiative. And this basically goes to the fact that, OECD recognized the need to help tax administrators conduct their risk assessment by getting some holistic information about multinational group entities in terms of their activities and financial information across the jurisdictions that they have presence. So that's what the country by country report is doing. So this is also a disclosure, just like TP returns filing, which is a disclosure. But this time around, you are disclosing financial information about a group of multinational entities, that meet a particular threshold. And that threshold has been defined to be, I think, 2.9 billion Ghana cedis, which, the suggestion that or recommendation that came from OECD was supposed to be 750 million euros. If you look at 2.9 billion Ghana cedis today and you convert it to euros, that gives you around 425 million euros, way below the threshold that was suggested by revenue authorities. And that's going to create a lot of problems going down the line. So just to put it in context, let's assume that the ultimate parent entity that is supposed to be obligated, to report this happens to be in a jurisdiction where they actually stick to 750 million euros. However, their consolidated global revenue is around 600 million. So from their perspective, they didn't meet that threshold, so they don't have that obligation. But if it has a subsidiary in Ghana, which is a constituent entity, all right, and they do that calculation, that 600 million, euros, all right, if you convert it to Ghana cedis, it's going to be something more than the 2.9 billion threshold, which means the constituent entity has to meet this obligation. So now they need to select a surrogate company to be able to file this on behalf of the whole group. So this is going to pose some challenges, and I think it's very important that taxpayers start having conversations with their tax consultants. But generally, that is basically the three-tiered approach: master file, local file, and country by country reporting. The most important point we need to learn from here is that there's so much more transparency than before. Revenue authorities, including the GRA, is going to get access to so much information about taxpayers and their associated enterprises globally. And that in itself is going to lead to some significant amount of TP audits going forward. So it's very important that taxpayers are more proactive in mitigating their TP risk exposures on a going forward basis. Thank you very much, Amaka.
Right. Thank you, Dr. Josh. We have a question that came in the chat, just very quickly. For the country by country reports, is the taxpayer required to submit this? OECD basically requires that exchange be done between the respective tax administrations. Can you just quickly confirm if for country by country report, taxpayers are meant to submit?
So it depends. The general responsibility is intended to be, fall on the ultimate parent entity. All right. So if the ultimate parent entity happens to be in a jurisdiction that has country by country reporting, and there are systems in place for them to automatically share such an information to all the tax authorities in the jurisdiction that they have footprint, all right, then that responsibility will lie with that ultimate parent entity who will compile all these, country by country reports and file in its jurisdiction, which GRA, which is the Ghana Revenue Authority, will automatically have access to if they have, a competent authority process and all the processes that they can access, all right? So in that case, the ultimate parent entity will be responsible for the filing. What the constituent entity in Ghana will be responsible for is notifying GRA as to which member of the group will be responsible for the filing, assuming that the whole group globally has met that threshold. Now, where for any reason, the ultimate parent entity happens not to be in a jurisdiction where they have that responsibility, or for any reason they don't have that kind of the systems for them to share such information automatically, there are a number of conditions that, if not met, and the constituent entity still has to report this country by country report, then there might be the need for them to be selected to actually compile this information and file with GRA. So typically it's the ultimate parent entity. If it's in Ghana and meets the threshold, that responsibility is very clear cut. But if it's a constituent entity, which means it's not the ultimate parent entity, such as a subsidiary, however, for some reason, GRA cannot get access to this information from other jurisdictions, then maybe the constituent entity might be forced as a surrogate to do that on behalf of the group with GRA.
All right, thank you, Josh. Mr. Kwame, very quickly, what is the rationale from a tax authority's perspective? What is the rationale for? Hello? Hope you can hear me? Yes. Okay, so Mr. Kwame, from a tax authority's perspective, what is the rationale of introducing a three-tiered documentation?
Well, thank you, Madam. I think that Josh has adequately dealt with the subject matter. I mean, for me, if I were sitting in that chair probably 2 years ago, I mean, it obviously brings much more transparency in the operations of the multinational companies than it used to be at the time. I mean, some of their transactions are quite opaque. I'm not saying this relatively, but that is the nature of how the companies have been structured. And it takes a lot of time to understand how they have been structured before you understand their operations, and to get to know what they do before you even get to the tax aspect of it takes a lot of time. So this obviously is good for tax administration. I think that you get to know the company better, especially when you look at the CBC, which is asking the company to tell you the taxes they pay in various jurisdictions. Then you'll be questioning if they are making losses here, why are they paying taxes? Those are information that were not available to us at the time. And I think that it is good. It's good for tax administration. I mean, generally, there's more transparency. There's also less cost to the company, as Josh mentioned, because you have only one master file which you are obliged to share with every tax administration. So essentially, it's good for tax administration. This is typically good for tax administration. Let me put it that way. Yeah. Thanks.
All right. Thank you very much. Mr. William, the revised TP regulation exempts some taxpayers from preparing TP documentation. I know I mentioned it earlier, but can you just provide more information as to which taxpayers qualify for this exemption?
Okay, thank you very much. Now, we need to be able to draw a distinction between the various types of exemptions that are provided. Essentially, what the TP regulations did was to introduce the tax jargon of what we call safe harbors, where we have simplified procedures for certain categories of taxpayers. There's a total exemption and there's a partial exemption on the documentation. The first one, which we call the total exemption, applies on the monetary value of the transaction. And so if the monetary value of the transaction does not exceed $200,000 US, the CD equivalent of that, you are not required to prepare a documentation covering that transaction. Now, documentation here is used in the technical sense, not in the loose sense. So in the past, of course, you have transaction documents that you sign arrangements and all that. But when we talk about TP documentation, the understanding is that you would have done comparability analysis, you have done all the tested parties, found the comparables, provided justification. So if the transactional value does not exceed $200,000, the law says do not go through that hassle, but file a return. That is, pick a form, tell the tax authorities the transaction you entered into, but do not justify the amount by which you sold it. So for example, if a father sells a car to the daughter, under the OTP regulations, you are required to file a return and then justify the amount, or say, or tell us why it is at arm's length. Under the current regulations, if the value of the vehicle does not exceed the CD equivalent of $200,000, there is no need to do that. So that provides a sort of relief for taxpayers and for small businesses who may enter into very minute transactions, which would not give us so much tax revenue if we are to call them to, as it were, build documentation to support it. So that's number one, the monetary value, which has a total exemption on the documentation, but does not exclude you from filing the return. Number two is a partial exemption, and this applies to the low value intragroup services. Now, the definition in the regulation conforms to the OECD definition. It adopts its line, hook, and sinker without modification. And so these are support services. They are non-core services like accounting, HR, finance, legal, those kind of routine services that are provided in-house. Now, what the law says is that if you provide that kind of service, we give you an exemption on documentation on the markup, but not on the cost. So for example, if a call center service is being provided to persons in Nigeria, Ghana, and say Togo, there will be a cost element to that. That cost element has to be allocated to the parties who are receiving the service. That cost element allocation, you must justify. How did you allocate to Ghana? What was the basis on which you said Nigeria should take, say, 60% of the cost? There must be a justification for that in the documentation. Now, the law says that if you be able to allocate the cost, but then the markup on the cost, the profit element that is being given to the party providing the service, does not exceed 3%. So it could be 1%, it could be 1.5, it could be 2.5. If that element does not exceed 3%, do not justify why you are charging, say, 3% or 2% or 1%. So that is a partial exemption on the markup. So when it comes to the low value intragroup services, the exemption on the documentation applies only to the markup. Now, the third category applies to technology transfer agreements. Over here, as you said, it must be a technology transfer agreement within the meaning of the GIPC Act. So the GIPC Act defines it. Number two, it must be registered with GIPC. And number three, the charge for these kinds of arrangements, so royalty, know-how, management and technical service fee, should not exceed 2% of net profit. And so if it does not exceed that, you don't have to justify the 2% of the net profit that you are charging, or a value not exceeding 2% of the net profit. But the requirements still follow that you must have a technology transfer agreement that is registered with GIPC, and you are also required to file a return. So in all these instances, the return is constant. It is only the documentation aspect. So technology transfer partial on the percentage not exceeding 2% of net profit, on low value intragroup services, partial on the markup not exceeding 3% of the cost, and for the monetary value, total when it doesn't exceed the $200,000. But remember that the $200,000, there's a caveat to it. Sometimes people split transactions, and the law gives the Commissioner General the power to aggregate transactions where people intentionally split them as part of a tax avoidance arrangement, which has been defined in the Revenue Administration Act and in the Enabling Income Tax Act. So those are the exemptions that you find when it comes to documentation under the revised TP regulations. Thank you.
Yeah, thank you, Mr. William, for that. You mentioned low value adding services. I have a question here. Perhaps Dr. Josh can answer this question. What type of activities are considered low value adding services?
Yeah, I think William has explained that, and the whole concept of low value adding is the fact that I'm providing a service to you that is not part of your core business. So it's support in nature and it's routine, so it's low value adding to the recipient of that service. So I think William gave examples such as accounting, HR, and so on and so forth. But when you give those examples, you need to put them in context. So let's assume that, me being the receiving entity, I'm in the HR business. Then if you're providing HR services to me, that is part of my core business. So that would not be a low value added, right? Because that is my core business. But if I'm in the business of manufacturing of products and you are providing HR support, because my core business is manufacturing of product, HR support is actually a back office or a support service that will enable me continue with my core business. So for me to find a proper compensation for such a service is going to be seen to be low value adding. And usually the remuneration or the compensation is going to be minimal. Hence, this low value adding, safe harbor provision, which came from the OECD, which the Ghana TP regulations has adopted. So for me, that is the easiest way you can actually envision what is a low value adding service. I mean, there are examples that have been given, but you need to understand the why behind the examples. And the why is very simple. Is the nature of the service that you are providing to your associated enterprise. Is it core to its business? If it's not core to its business, all right, and it's pretty much low value added, then you can argue it's low value added. The good news is the regulation also gives examples of some types of services that are not low value added. So for example, contract R&D cannot be low value added. So it's a service, all right, you've been contracted to perform R&D service, but that type of service is seen to be high value, all right? Procurement, can be seen to be a service when you are doing sourcing arrangements, all right? That can be seen to be a service, but the regulation actually clearly specifies that that is not low value added. So as much as we have that definition, the regulation also gives you examples of other services that might not be core to the business or could be core that are clearly not low value added. So I think that understanding of what the low value added is and going through the regulation to look at the list of services that are not low value added is what is going to be helpful for taxpayers in making that determination whether they are low value adding services or not.
Okay, thank you very much, Dr. Josh. 2020 was a very peculiar year because of COVID-19. And due to the economic impact of the pandemic, the OECD recommends that in carrying out your transfer pricing analysis for financial year 2020, more recent comparable data should be used. However, most databases would not have 2020 financial information by April 2021, which is the filing deadline for most companies with, at least companies with the December year end. Mr. Kwame, what should the tax authority or how should the tax authority handle this issue?
Thank you, Madam. GIA has another cycle of 3 years. So 2021, 22, 23, 24. So probably the earliest time a company will be scheduled for audit for 2021 will be 3 years away from now. In the event that a company's audit cycle falls within 2021, depending upon the industry, one has to be strategic in this matter. I'm not going to go for companies which are in the hospitality industry because it's broken down. I'm not going to worry about airline companies because they are not flying anywhere. Oil and gas, some of them have collapsed. So if you ask me, which areas should I be concentrating on? Telcos, health industry generally, entertainment, because the cinemas broke down, but there are a lot of people are using home entertainment now. Netflix is making a lot of money. So it comes back to the issue of, let's say, in Africa, what are we doing about VAT on those services which are being rendered? So if you do some amount of work in terms of what one has to do, my emphasis wouldn't really be on data which is to begin with non-existent, because the comparables definitely are not there to begin with, and even if they are there, as we talk now, they'll be flawed. The airline industry has collapsed. What data are we looking at? The hospitality industry has collapsed. Hotels don't have clients. What are we looking at? So I think that the emphasis should rather be on the areas that have prospered from COVID. For me, that would be the way I would look at it. That my emphasis would not be on where the problems are, because obviously there wouldn't be any data for you to compare to begin with. So I'm going to look at where I know there has been prosperity. The telcos have gained a lot. Zoom, we are using a facility which, from my information, has gone up. 50% over. Zoom has had about 50% increase in participation. If you look at other companies of the sort, have really made a lot of impact. And I believe that is where the emphasis should be. So if you ask me as a tax practitioner, my emphasis wouldn't be on those which have made losses, honestly lost. I wouldn't bother too much about. There wouldn't be anything to look for anyway. So why should I waste my time comparing data which I know is not going to give me anything? And you have time, resources, staff, energy, which are constrained to work with. I'd rather put my emphasis on the area that I know are lucrative. I'll look at healthcare, the companies making all kinds of products for the market. Excuse me. There's those who are in the logistics, those who are in delivery. Those are the areas that have come up now. So my emphasis will rather be on areas that have shown prospects and are actually making money. I would rather not concentrate on those ones which I know very well and not doing well. Yeah, that's my take on that.
Thank you, Mr. Kwame. So from your own perspective, the FRA should focus on industries that are booming during this period. However, one of the major issues taxpayers may have, because they need to prepare their master file and local file and submit it within this time deadline, getting adequate data to analyze their related party transaction, particularly for 2020, is a major challenge. So Dr. Josh, what should taxpayers do when preparing this documentation for 2020?
All right, thank you, Amaka. I think, this is a very important question. And, we had a previous webinar on this for the Africa Middle East region. And we had, representatives from both the GRA and, FIRS Nigeria being part of it. And they recognize that this is a big problem. I appreciate Mr. Kwame Owusu's, view that the focus should be on the industries that have actually thrived, during this pandemic period 2020, and then less focus on the industries that have been adversely impacted. But I think that is just a partial solution to the problem, but that should also be appreciated. And let me put it in perspective. It's true that there's been an adverse impact, and it's not been, the same across board. Some industries have actually thrived, like the telecoms. The majority of other industries have struggled. But it depends on the type of methodology that you use to demonstrate that your related party transactions or your control transactions were actually at arm's length. If you use what we call profit-based methods, which are usually one-sided tests, such as the resale price method, the cost plus method, or the transaction net margin method, where you made use of external data that come from data-based providers, then this challenge becomes very significant, because these databases takes a while before this information about independent companies take a while before they get into the public domain, before they're incorporated into these databases and then made available to the public for its use. So typically for financial year 2020, you're not going to get independent companies' financial information in these databases for 2020 by April 30th of 2021. Which is the deadline for most of the tax-paying entities in Ghana that have December year end. So that becomes a problem. So if I had such methods, TNMM, for example, for most of my transactions, and it happened to be a case whereby I'm in an industry that was hard hit, all right? Then I'm looking at my 2020 financial results, which was hard hit, and I'm trying to compare that with comparable, companies or service providers, what have you, whose financial information that I have access to only cover years that were normal periods. So I'm not comparing apples to apples, all right? So I have, let's say a loss-making entity, and my comparables for those particular periods were actually positive, margin companies, all right? So it will look like I didn't conduct this arrangement in an arm's length manner. That creates problems, all right? So it's important that we get this 2020 data. The question is, will revenue authorities recognize this problem and be flexible in terms of when those taxpayers file their TP documentation, which is the master file in the local file? If they are not going to be flexible about it, then the question is, are they willing for them to resubmit once they get more current information? Now, let me go to the issue of sectors such as telecom that are doing well. One thing we need to recognize is that, especially when you are dealing with cross-border transactions, transfer pricing looks at it from two perspectives. So let's assume that you have a local telecom entity that has done very well in 2020 because of the positive impact, this time in quote, positive impact of the pandemic. All right. Now, its margins are pretty high. If it had 2020 financials of similar companies within that same industry, their margins will also be high, such that if you create your benchmark range, that high margin most likely might fall within the range, and you can then conclude that you've met the Amslan standard. However, if you don't have information for 2020 and you took the comparables in the same industry for prior years, all right, what you're going to see is the possibility that that 2020 result of that telecom company is going to lie above that range, which means, you know, maybe the other jurisdiction might think that for one reason or the other, profit has been shifted to the Ghana, and that creates problems. So whether it's, you know, in a high performing industry or in an industry that is adversely impacted, this challenge cuts across board. All right, so I think it's something that revenue authorities have to recognize, because OECD has recognized it and come up with guidance on it. And it's important that revenue authorities, including GRA, are very clear, because yes, it's much closer. When you look at Nigeria, our deadline, you know, for most of these is around July, you know, June 30th, 6 months afterwards. So that might not be as, you know, severe a problem as that of Ghana's case. So I think this is something GRA has to take a look at, and hopefully they will be more flexible in terms of the filing deadline or the possibility of resubmission when new data becomes available.
Thank you, Dr. Josh. We're getting a lot of questions concerning the technology transfer agreement. Mr. Eric, for taxpayers to be exempted from documentation requirements, the fee charged for royalties, know-how, management, and technical fees should not exceed 2% of net profits. What are the implications of this provision with respect to double taxation risk?
Okay, thank you, Amaka. I think if you look at the safe harbor rules with respect to the technology transfer agreements, William has, I think, adequately explained the provisions and how to be able to enjoy the benefits of a safe harbor rule. I think the main reasoning behind Regulation 14.8 in terms of the technology transfer agreement and the associated rates in the second schedule was to make the life of taxpayers simpler in terms of simplifying the application of the transfer pricing regulations in terms of documentation. I think if you meet the threshold, then you would be able to enjoy the provisions within the safe harbor rules. However, where the rates that are paid by probably the licensee here in Ghana with respect to maybe a licensor or between the principal and its associated enterprise in Ghana, where the rates fall below a required minimum in a jurisdiction, in the jurisdiction where the Ghana company has the agreement with, and looking at the domestic tax legislation of that jurisdiction, issues of transfer pricing will arise in terms of the rates. Then you have a risk that the tax administration of that particular jurisdiction, if Ghana has a double tax agreement with that country, will try and make an adjustment, a transfer pricing adjustment, to try and bring the rates or the charges paid by probably the Ghana company to the principals outside to that jurisdiction, to try and bring it within the domestic tax transfer pricing regulations. So then you find that the principal who is in that jurisdiction that Ghana has a transfer pricing, a double tax agreement with, will be faced with the issue of paying double tax, paying tax on an amount that it may already have paid tax, probably withholding tax here in Ghana. But because it falls foul of the transfer pricing regulations in that jurisdiction, its tax administration is required to make appropriate transfer pricing adjustment. And this is backed by Article 9 of the double tax agreement between Ghana and its treaty partners, where it allows a treaty partner to make an appropriate adjustment where it believes that an arrangement between related parties or persons in a control relationship has not been done with regard to what independent parties in similar situations would do. In a situation like that, then the Ghana Tax Administration or the tax authorities may be obliged through the mutual agreement procedure to make an adjustment to probably relieve the taxpayer or to relieve the principal or the associated party here in Ghana of the double taxation. So it could raise double tax issues with respect to where the rates do not conform with the TP regulations of the jurisdiction with which Ghana has a DTA. But then Ghana may, under the same Article 9 of the double tax agreement, make an adjustment to compensate for the double taxation that the principal may pay in the jurisdiction in which it is resident. Thank you.
Thank you very much, Mr. Eric. Josh, can you give an example? Any additional thoughts on this?
Yeah, I think Eric has explained it very well. But just to put it in perspective, unlike the other partial safe harbor provisions that were given, especially when you look at the low value adding services, where I think the possibility of having a double taxation risk is minimal. In this particular case, there's the high tendency for you to see a more frequent occurrence of such risk. And the reason I'm saying this is that when you look at low value adding services, typically when you look at independent arrangements, all right, the type of remuneration is usually the cost of providing that service with a markup. So even if you chose not to go with the safe harbor, all right, of low value adding service, that says that, okay, as long as it's up to a markup of 3%, all right, you need not demonstrate with a very detailed analysis that that 3% markup is reasonable, all right? Now, that choice of 3% markup on service costs is typically what you would have actually found or done if we had done, an arm's length analysis, because typically when I'm a service provider of something that is not core to your business, the remuneration is typically a markup on the cost of providing that service. The question is, how high would that markup be? And if it's up to 3%, then there's no need for me to perform a very detailed analysis, as long as it's a low value adding service. So you don't see a lot of discrepancy in terms of the structure of the remuneration because the base is pretty much the same. Now, when it comes to this particular case of the technology transfer, what you see is a percentage of net profit. However, in a lot of arrangements between two independent parties, where you have a licensor licensing a technology or a marketing intangible that drives the top line. If I give you a trademark or trade name, typically it's to drive sales. If you're using an Apple product, people buy Apple products because of prestige, of its coolness or whatever. It drives sales, all right? So marketing intangibles drive the top line. Most technology drive top line. So typically an independent arrangement will take a percentage of the variable that they are driving, which is the top line, which is sale. So you go into the database in terms of intercompany agreements between two unrelated parties. For the license of such types of intangibles, you see percentage of sale. However, JIPC, for you to actually enjoy this safe harbor is being limited to a percentage of net profit, which is a totally different base. And that is where there's a source of discrepancy. And this is a big problem. And this has been driven by, ATAF, which is Africa Tax Administrative Forum, where they've made such suggestion as a means of, curtailing the amount of outflows from Africa. And Nigeria has implemented an aspect of it in our regulation. And this is a big problem. And we've written articles and engaged the tax administrators that if you really want to have ease of doing business in your country and continue to attract foreign direct investment, you need to align with the absolute principle as much as possible. And even if you're going to give safe harbor provisions, they shouldn't be significantly contrary to what would be done if you're performing an arm's length analysis. So for me, this is one of the biggest problems that I see in terms of the simplified approaches. The others are fine, but this is a potential area of risk. And as Eric clearly indicated in this simple example, if you happen to have the licensor of that particular intangible in a jurisdiction where they don't have such a safe harbor, and they follow the Amslan principle as prescribed by the OECD guidelines, and we can talk more about that later on, and they came up with a royalty rate of, let's say, 3% of net sale. However, the local entity has elected to go with the GIPC rate, assuming that it meets that threshold of 2% of net profit. Clearly, you're not comparing apples to apples, all right? So you have a double taxation risk. And if there's no double tax treaty between Ghana and that jurisdiction, then the group has to actually bear this risk. And there's no procedure that they can actually embark on to resolve this issue. So if I'm an investor and I'm coming into the Ghana market, I have to be very conversant of this risk. And that could be part of my decision to invest in Ghana, all right? So sometimes we need to think about some of these issues more holistically, when we come up with some of these policies. And for me, that is a very big problem. The good news is all these simplified approaches or safe harbors are elections, all right? That means a taxpayer can choose not to elect, to go with that safe harbor. So I'm not required to actually do that. But if I choose not to elect, then I have to prove from an arm's length perspective that my percentage of net sale then makes sense, all right? And hopefully, I believe the tax administrators will respect the arm's length standard, because that's a standard that has been accepted by almost every jurisdiction globally. Even Brazil, that used to go against it, has gone back to OECD and is aligning, let alone small players like Ghana, Nigeria, and the rest. We need to align with the global standard, which is the arm's length standard.
Thank you, Dr. Josh. A follow-on question for Eric. With respect to considering the provisions in the TP regulation, is there now a requirement to register technology transfer agreements before the Ghanaian tax authorities will allow it for tax deductibility purposes? Must it be registered?
That's raising a very topical issue in Ghana with respect to the registration of technology transfer agreements. If you look at the income tax law, deductibility is based on certain principles, especially if you look at the Income Tax Act 896, I think sections 8 and section 9 deals with when you can deduct an expense, and a technology transfer expense, or more specifically payment for management and technical services fees, is a deductible expense under the Income Tax Act. I think this issue has been litigated upon even up to the Court of Appeal, where the court has held that non-registration of a technology transfer agreement will not disable a taxpayer who has incurred the expense from deducting it from its profit and then arriving at a correct chargeable income. There has been a confusion as to whether non-registration will disable you from enjoying the benefits under the Income Tax Act of deducting that expense. I think previously the tax administration, I'm sure Kwame also will be a better person to speak to that. That's especially the TP regulation unit has held that non-registration of a technology transfer agreement would lead to the tax administration disallowing charge for management and technical services fees. But with the recent Court of Appeal decision, non-registration would not disable you from enjoying the benefits of Section 9 of Act 896. When it comes to the TP regulations, I think the TP regulations is subsidiary legislation, so it's subservient to the Income Tax Act, and by implication to the interpretation that the Court of Appeal has placed on non-registration vis-a-vis deductibility of an expense. So if you haven't registered it, I think you may not be able to enjoy the safe harbor rules in the TP regulations. But as to its deductibility, I think that has been determined by the courts. Thank you.
All right, thank you very much for that. Another question, moving away from the technology transfer agreements. Mr. William, the regulation also includes the concept of risk as a determinant for returns. What is the importance of risk in determining the arm's length price in a controlled transaction?
Well, thank you very much. Now, risk is important because, as we always say, risk goes with reward. And so if I enter into a transaction and then I'm assuming a higher level of risk, then I'm supposed to be getting a higher level of compensation from that particular arrangement. Why do I say this? So two parties enter into a transaction. One person bears the risk when there's a loss and everything goes bad. The other party does not, commits nothing whatsoever, and then walks away clean. When there are profits that have to be generated, when there's income that has to be determined, you must factor in the risk, because the risk determines the extent to which the person must profit. So if the person is assuming a higher risk, then the understanding is that under normal commercial rules, the person must get what? A higher return. It is that way in determining interest rates or lending rates. If you go to a financial institution and you are not credit worthy, it means your risk of default is high. Therefore, you have to pay a premium for that risk. And that is why we have junk bonds and other things that come in. So risk is important in determining the appropriate income when it comes to control transactions. Even from a tax administration standpoint, risk is important in determining which of the transactions I have to pick up for audit. Because bear in mind that resources are limited. And so you cannot be chasing a transaction that is worth 100 cedis. And I think that is one of the key improvements. And that is why the TP regulation has done wonderful when it comes to, as it were, giving a monetary value. Because if the TP documentation may cost me $10,000 and the transaction is, say, $1,000, the question is, why do you have to spend compliance costs of $10,000 on a transaction worth $1,000? Which may bring up the highest revenue being 25% of it, of being, say, $250. So whenever it comes to risk, we look at it both from the transaction perspective of what the person is supposed to earn, and we believe that the higher the risk, and that is why you see it a lot when it comes to the functional analysis, the functions performed, the risk assumed, the assets employed. It's critical when we are doing the analysis to be able to get to a point of determining the appropriate income. And from a tax administration standpoint, if you want to do audits, you have to use a risk assessment approach, because you have to deploy your resources to areas where you'll be able to get enough revenue and ensure that the complexity of the transaction in itself is enough such that it is able to bring in the needed revenue. I think this dovetails into other areas such as cost-sharing agreements and other things that I believe other panelists will speak on as we go along. But risk is important in every TP analysis that you do, every comparability analysis that you run. Risk would determine ultimately the income that each party must earn, and therefore the profits that will be generated out of that transaction for purposes of taxation. Thank you.
Thank you very much. Mr. William mentioned the fact that even tax authorities will need to carry out some form of risk assessment in determining the transactions or determining the taxpayer they would like to audit. We have a question here. Mr. Kwame, if you could answer, please. It says, are there any specific types of transactions that tax authorities focuses on the most? I know you mentioned earlier with respect to 2020, they should focus on industries that seem to be booming during the pandemic. But prior to that, are there any type of transactions the tax authorities tend to focus on?
Can I get a better explanation for the? I don't seem to understand it. I mean, when you say transactions, what are you referring to? I'm sorry.
So for example, if I leverage on my experience in Nigeria, I know that if a taxpayer has a procurement transaction, that is considered a high risk transaction. Therefore, the tax authorities will most likely audit that client to try and understand whether the related party transactions were conducted from an arm's length perspective.
Okay.
In Ghana, are there any specific transactions that the tax authorities consider high risk, and therefore they would most likely select that taxpayer for an audit?
All right, thank you very much. I mean, straight away, I'll say when payments are made for intangibles, I mean, the typical example is what Josh made. We've been at this for years, for the past 5 years, we're doing this. That what drives sales? I mean, I do appreciate that sales would be driven by the intangible, but there's cost to the sale. I mean, the sale just doesn't pick up simply because the product is or the service is introduced onto the market. And throughout my stay at GRE, I never had one functional analysis who justified why payment for any intangible should be X% and not Y. I mean, not one. I didn't have it. So I sort of have a difficulty in appreciating the fact that because sales are driven by the top line, let's say the IP, you should get the best payment. Because like I'm saying, if you have literature that we have to share, I'll be most grateful, Josh. I still haven't had that yet. So I would say that where there's payment for IP is a high risk. And you already mentioned procurement is a high risk. If the related party transaction between the group amounts to about, let's say 80%, a very high risk. So those are indicators one has to look for because, I mean, and the risk is high because globally, I think that multinationals account for about 60% of the world trade. And they are not more than 500 of them. If you look at the mining and, I mean, look at the oil and gas, manufacturing, it's the BPs of the world which have actually put in money in, reinvested in other areas. So if you have them doing businesses among themselves to the tune of about 80% of their revenue, then it's a very high risk. So I'll look at the quantum of trade between the multinational companies, and especially, of course, that obviously brings in procurement because there's always going to be invoices which are issued from countries where you have no idea whether there are any human beings living there. That is why I said that some of the operations are very opaque because, I mean, there's always mentioning of where, I've forgotten some of the islands, where the only thing there is an office and a desk. There were no human beings there, but that's where the invoices are generated. So the areas, the primary areas I would want us to look at, I mean, any tax authority should look out for where they are paying for intangible, because that is a subject area which still has difficulty in assessing. I mean, what is the value for Barclays logo? I mean, it is sponsoring the Premier League of UK. So how much money will be sufficient to be used as payment for that intangible? So it is an area one has to look at where there are purchases, where the cost of transactions between the companies are high, and then where there are persistent losses of companies which do a lot of cross-border trade, then it also has to be looked at, irrespective of the fact that they are making losses. Then it comes back to what we were discussing initially with Josh. If I'm paying 3% for use of the IP, if the company makes losses, what do I pay for? I'm only adding to the losses. And the losses may have come about because of other factors which are not for discussion now. So there are a lot of other areas that we can look at, but these are the areas that I've mentioned for starters. That there are red flags that would normally you would see if you think that something, I wouldn't say something untoward, but red flags always come up when you look at some of these transactions. And once you see them, then you should be aware that you should be looking more at them for other purposes. Yeah.
Thank you very much, Mr. Kwame. Dr. Josh, Mr. Kwame emphasized on intangibles a lot as a high-risk transaction. Now, there are specific provisions included in the revised regulation with respect to intangibles. So what are these provisions and what is the impact on taxpayers?
Thanks, Amaka. And I think it's important that we try to have a better appreciation of this particular type of arrangement, intangibles. And I have to agree with Kwame. Intangibles has always been the most complex of all arrangements in transfer pricing, even in the most advanced economies. When I started my practice in the US, my specialization was on intangibles because of its complexity. Unfortunately, for emerging economies, irrespective of the fact that UN came up with a TP manual to make it much easier for tax administrators in emerging economies to better understand TP, I don't think we've done a good job of really trying to understand this very complex area. And sometimes the easy way to go around a complex issue is to come up with a ruling, all right? And that's the reason why, we have this GIPC ruling to help, go with the safe harbor and deal with the consequences later, because I don't want to spend time to understand such a complex area. FRS has done something similar, and I think it's something that we need to really understand. Now, let's look at it this way. There's no way any business will make significant investments in technology in their industry if they didn't believe that it's a means of earning excess profits, right? Because the whole idea, and that's the reason I need to understand that TP is predicated on economic theory. The whole idea is that if we all are doing pretty much the same thing and we've not differentiated ourselves from each other, and there's easy entry into the market, we're all going to earn normal profits. Nobody is going to be able to earn above normal profits. That's the basic concept about competitive markets. Now, once you move into an industry where you have, let's say, an oligopolistic market or a few players that dominate a market, what you typically see is that those few players have been able to differentiate themselves in the marketplace, either by being able to establish themselves as having the best quality of products, have done a very good job of really having some kind of relationship with their consumers, that consumers are so loyal to them irrespective of their flaws. I quite remember in the US when Toyota Camry came and they had a problem, and the US Congress tried to really bash them, and so that they will reduce demand for Toyota. It never really had an impact because Toyota has been able to establish some connection with the middle income players, and they were doing better than the Michigan and the Detroit American companies. So you realize that, look, intangibles are critical. Once you tap into that consumer loyalty, it becomes very difficult to dislodge that person from the consumption of that particular product. And it involves years and years of investment, either in the know-how or technology, which brings about efficiency or the quality of the product, or marketing intangibles such as trademark and trade name that brings that brand awareness and brand loyalty. So let's put that aside. Now, what do we have in the provision that is different from previously? The provision has given us a little bit of guidance, all right? First thing you need to understand is what is the form of intangible? There are different forms of intangibles. There are two types, all right? The trade intangibles usually include technology, know-how, what have you, in terms of the development of the product, for example. And there are marketing intangibles such as trademark, trade name, brand name, that has to do with the marketing of the product itself, all right? So you need to understand the form of that particular intangible. The next thing is you need to understand the nature of the arrangement. Is it a license of that intangible, or is it an outright sale of that intangible, or is it a cost contribution arrangement where we came together to develop that intangible for our mutual benefit? Depending on the nature of the arrangement, the remuneration and the analysis is going to be different. All right, so you need to understand that. Okay, having understood that, you need to now figure out who amongst the associated enterprises is the legal owner of that intangible. Now, being the legal owner of the intangible does not necessarily mean that you have all the economic rights to the proceeds from that intangible. So there's a distinction between legal ownership and those who have economic rights to that particular intangible. And that's the reason why the revised OECD guidelines laid emphasis on the functions that associated enterprises have performed in developing that particular intangible to where it is today. And that's what is called the DEMPE functions. And that has been introduced in these regulations. The DEMPE functions talks about who are those who are involved in the development of this particular intangible, enhancement of it, maintenance of it, protection of it, and the exploitation of it. So you need to understand that, because whoever plays that role is entitled to some of the proceeds or the returns that are being generated because of that intangible. And that is where a better appreciation of the intangible arrangement will tell you that, previously, before OECD came up with this, we seem to give almost every return to the intangible to the legal owner without recognizing that even the entity that is exploiting it is adding some kind of value in the exploitation process. But today, you need to look at the DEMPE functions in its entirety. Having done that, and now you know the functions and all that, now the question is, how do I determine the appropriate remuneration? All right. Now, there are different methods you typically use, but the most common is look at agreements between independent parties and the type of remuneration that is usually given to them. And there are such agreements. Now, the challenge is that intangibles in itself is supposed to be unique and valuable to the beneficiary and to the licensee or the transferee. All right. Now, if it's unique, then how then do I get agreements that are comparable to something that's unique? And that is the reason why it's a very complex area. But what it will tell you is give you an indication of the type of remuneration arrangements that independent parties do enter in. And that's where it's important that tax administrators look at this, because what you see, there are a number of know-how arrangements, there are a number of trademark brand name arrangements where the remuneration between two independent parties is a percentage of revenue. That is an example of an Amslan behavior. You understand me? Now, GIPC approving a rate is called a rule of thumb. It's not based on Amslan behavior because they're not looking at a database where they're looking at agreements between two independent parties. So I do appreciate the safe harbor to make simplified things. But when it goes to the Amslan standard, we need to go beyond that. So clearly, there's a lot to be done in this area. I know it's an area of risk, especially those in the FMCG space, where marketing intangibles are very important, where know-how is critical in terms of efficiency, because these are high volume, low margin businesses. You need to understand that. Now, the last distinction I think is critical is that there's a difference between the importance of some types of intangibles, such as marketing intangibles, for B2B businesses, that is business to business, where you manufacture a product that is an input or an intermediate to another product. You don't need to do a lot of advertising. You just know you are a captive supplier, right? But when you're doing business, which is B2C, business to consumers, where you have a larger population, the importance of marketing intangibles escalates significantly, and you cannot underplay it. Look at the commercial basis. Businesses are continuously going to invest in R&D. There's a reason why today there's something called Silicon Valley. There's a reason why fintech is making so much money. How come Amazon has become such a great business? How come Tesla, which is not as profitable as Toyota, is one of the most highly capped businesses in the world? It's all about technology. How do you then underestimate its importance? So really, my advice to revenue authorities is let's take this area seriously. Let's try to understand it. I know it's complex, but there's no harm in educating ourselves, and let's see how best we can actually deal with it. Because now the revised guidance gives us a lot of latitude in terms of the DMP functions and all those guidance for us to appropriately determine the appropriate remuneration for intangibles. Thank you very much, Amaka.
Thank you, Josh. So moving on to another question for Mr. Kwame. With the amount of information the GRA would receive due to the filing of transfer pricing returns, local file, master file, country by country reports, should taxpayers envisage an increase in transfer pricing audits? And is the GRA adequately equipped to process the amount of information that they are requesting from taxpayers?
I'll take the last bit of the question first, whether GRA is equipped. Technically, yes, I'll say that. But in terms of numbers, no, because I mean, they have a limited number of staff. I think that even now that the numbers have gone up, you are looking at about 20, just about 20, more than 20 people. And that really is a no. I mean, if you are looking at an audit, assuming that without admitting that an audit on the average may take even 6 months, which in some cases is not likely to happen, and you have a staff of 20 doing that's a lot of work to be done. And for companies which, and granted that we are looking at the turnover that we are talking about, I mean, there are quite a number of them which may be available for audits. So in terms of the numbers, I would say that would be quite difficult, but that would be challenging. Let me say that would be challenging. But in terms of preparedness for the information which is coming, I mean, fortunately for GRA, when was the idea of getting the EUI established, the architectural software that was purchased had a component of it which can easily take care of the CBC reports. But I'm aware that some staff have already gone to have professional training on how to manage that. So technically, there are people there who can competently handle that. But like I keep saying, the numbers are such that it's not going to happen immediately. So that ties into the earlier question, whether there will be a lot more audits. That would be difficult for me to say. I'm no longer in the seat, but I'm hoping that with technology, they'll be able to do more than we're doing previously. I think so, because there are lots of things that one had to do manually, but now there's a software which is used for functional analysis, which we didn't used to have at the time. So I believe that it is possible that there will be many more audits now than we used to have in the past. Yeah.
Thank you very much, Mr. Kwame.
Thank you.
Mr. Eric, the TP regulations didn't specify penalties, but reference was made to the Revenue Administration Act. So what are these penalties, and do you think that they would help to drive behavior with respect to compliance?
Thank you, Amaka. I think if you look at Regulation 16(1) and 2 of the LI 2412, it references the Revenue Administration Act in terms of penalties and interest, as you correctly stated. And especially if you look at the Revenue Administration Act at 915, there are very steep penalties for infractions of the tax laws. For example, underestimating the tax, misleading statements, not filing returns on time, not keeping contemporaneous documentation. All these are infractions of the tax law. And if you look at the Revenue Administration Act, it provides very steep penalties and interest for not enforcing or not complying with these rules. So I think for taxpayers, it is incumbent on taxpayers and on businesses and enterprises to ensure that we maintain the contemporaneous documentation as required in the TP regulations, to ensure that they file their returns on time, and also, very importantly, not to make misleading statements to the revenue authorities in their transfer pricing documentation. So I expect that with these new transfer pricing regulations and looking at the penalties and interest in the Revenue Administration, our taxpayers will ensure that the requirements provided for in the TP regulations are met, and are met accurately and consistently. Thank you.
Thank you, Mr. Eric. Mr. William, from your experience, how will the revisions in the TP regulation improve compliance?
Thank you very much for the question. I think if we look at it critically, what the TP regulations have done is to, as it were, simplify certain approaches, introduce safe harbor, provide clarity on certain things. So in the past, we didn't have clarity on things like package deals. Now it's arguable that you can have an understanding of it. Cost sharing arrangement was something that was not dealt with. Now there's clarity on it, even how financial transactions or arrangements would be determined, how the Commissioner General would view them. Because if you look at the Income Tax Act, there was a provision under Section 31 which said that the Commissioner General has power to recharacterize debt financing as equity financing. But then there was no clarity as to how that will be done. In the regulations, you see an attempt to provide clarity on what would inform that decision, because that is critical. If you have a debt, if you have a loan agreement or a finance arrangement, and one day Commissioner General says, I don't think it is, I think it's equity, it has serious implications for the parties. Now, there was a need to provide clarity on that so that taxpayers will know what they need to do in order to comply. Bringing about the simplified approach or the safe harbor provisions, for me, is one of the high points of this regulation, because then it, as it were, gives small businesses and very low transactions and individuals the space to be able to move about without worrying their heads over documentation and things to do with it. So clarity has been brought. There are a few issues that are outstanding. I like the back and forth on the technology transfer arrangement. I can speak to a fact that that was not the intention. And when the regulations were being drafted, the intention was to harmonize the two regimes between the technology transfer regime and the TP regulation regime. That was the idea. But what came out did not fully reflect that. I think this was the compromise solution, as it were, which in itself has problems. But there were several attempts to harmonize even TP and then customs there was that attempt, but in the end, the final regulations that came out, that harmonization didn't take place when it comes to customs adjustments and all that. So on the main, I think it's done well, providing clarity on certain aspects. Things like services, you see that now there are clear provisions on shared services, duplicated services, shareholder arrangements, and what would not amount to an arm's length charge for services, why certain services would not be deemed to qualify or meet the benefit test and therefore will be disregarded or recharacterized for TP purposes. All these things are important so that taxpayers will know from day one as they consult with their tax consultants and TP advisors what I need to do so that I do not become, as it were, a candidate for audit. And when the audit is even done, I do not end up having several penalties and interest being imposed on me. So in the main, I think the TP regulations have done well. Of course, there's always room for improvement. As you can see around the table, there are disagreements on areas that I think that we could have done better. But in the main, I think that it's done well for compliance. As far as taxpayers are concerned, they will know in detail what is expected of them as opposed to what existed in the past, and they'll be able to comply and not have issues such as interest and penalties being imposed on them later on for non-compliance. Thank you.
Thank you, Mr. William. Dr. Josh, very quickly, because we're running out of time, with the increased compliance requirements, what can taxpayers do to manage their risk with respect to transfer pricing? If you can answer in 1 or 2 minutes, then we'll wrap up the session. Thank you.
Thank you very much. No, I think William has summarized this clearly. There's much clarity, and one thing about these regulations that it should try to achieve is to bring clarity to taxpayers so that taxpayers can comply in a manner that is win-win for both parties. So based on this clarity and the fact that the compliance burden, irrespective of the safe harbor, has gone up, because if you've qualified for country by country reporting, you need to prepare it or notify the revenue authorities and make sure it's filed. Now you have the master file and local file. You just don't need to keep the contemporaneous documentation, but you need to file them, which is a big difference. So there's a lot of compliance burden for those who qualify to meet those compliance burdens, which means that taxpayers have to be very proactive. So my advice to taxpayers would be, do an evaluation of your, controlled arrangements with associated enterprises. Figure out, which transactions based on the more detailed guidance on all these transactions. There's more detailed guidance on service transactions, intangibles, financial arrangements, cost contribution arrangement. You need to have an understanding of all these and see what you have in your existing documentation. Should you make any changes in order to mitigate your risk exposure? In terms of filing deadlines, how do I meet these deadlines? And if, for example, this 2020 COVID-19 impact is such that it's going to be very difficult for me to submit a master file and local file that is up to date, can I reach out to the tax authorities and seek for some exemption or some extension? There should be some engagement, because this is an extraordinary event, COVID-19, and there's been a lot of concessions that government and government agencies have provided under the circumstances. So I don't think taxpayers should be shy from engaging. This issue, as I said, was brought up during our last webinar, where we had the current head of TP at GRA being part of it, and he recognized some of these challenges. So I think there should be more engagement. There should be a health check review done internally to look at your areas of risk exposures and how do you mitigate them. This is the best time for businesses that do not have in-house TP experts to talk to their TP consultants. And I need to stress, this is a very complex area of taxation. It's not just a matter of interpretation of the regulation. It's a matter of understanding the application of a highly complex concept called the Amslan standard, which is predicated on economic principles that we need to appreciate and be able to then implement. So my word will be proactivity, proactivity, proactivity in order to mitigate risk exposure.
Thank you very much, Dr. Josh. And I would like to really appreciate each and every one of our panelists that have been on this session. It has been a very educative session, and this is mostly due to your contribution. So we really appreciate you taking our time to join us on this webinar. We also want to appreciate the panelists, the participants of the webinar. We had at some point about 100 people join in on this webinar. So thank you so much for joining us on this webinar. We apologize that we couldn't answer every question that was raised. However, because we have your email address, we'll attempt to answer the questions and email it to everyone that participated on this webinar. So thank you very much once again for joining us. More details as to future webinars will be communicated. Thank you and have a wonderful day. Thank you very much.
Thank you.
Thank you.
Thank you.
Thank you.